Good morning. Today, setting up credit spreads based on strikes and strike widths. Today on the Traders Workshop. All that and more after the bell. Yeah. I know.
I didn't know they played that song in the hookah trading bar.
Yeah, I'm in the hookah bar here. It looks like, holy cow, is it dark in here. Yeah, I'm in the options lab today. All right. Good to see you guys. Happy Thursday. So today's show, we're going to work on another Reddit question. I'm starting to enjoy these Reddit questions. I think they're Reddit anyway. And, you know, we get a lot of things that I would say are in the beginner realm of things there, which is also kind of interesting because I know we do some heady things from time to time. So it's nice to kind of get to basics a little bit on occasion, right? Mm-hmm. I guess I should ask you, how are you? Did I ever say that? No. On top, Jason.
Do you honestly care?
Not really, no. Lorenzo, and down below, Mark, Phillips. My two lads, partners in crime here. This is the Traders Workshop, as you know. And don't forget to follow us on YouTube and subscribe. That's always fun. Here's the question, boys. You ready? I'm sending it out for everyone to see. I'll read it. I recently started trying out credit spreads. I got to say I'm a bit confused about how to pick the right strikes and widths of strikes. I keep second guessing if I'm choosing the right setup. Okay. So, wonderful. Now, I know we have, you know, Jason, you mentioned pre-show about the, you know, options of the Swiss Army knife of things. And let's assume this person has a bevy of things in the toolbox, so he can use all of the Swiss Army knife. And this is just one of the blades. I love credit spreads. I will say that. It's one of my favorites. I think they're easy to understand. They are risk defined. So why don't we do this? Let's do what a credit spread is. Why don't one of you guys tackle that? And then it's just so we know for the very beginner people what it is that we're talking about in the first place. So let's do a put credit spread. I think they call them a put full spread.
That's an easy question that I'll take because Mark is smarter than me. He could take the more heady questions.
All right, here we go.
So a put credit spread is when you purchase a put and on the same expiration, you sell a put that's closer to the money. The result of that is that you receive cash in exchange for the risk of price closing below the spread. So I guess below the short strike. Yep. The actual risk is the spread times the number of options that number of shares that the option represents. So times 100 usually. And so like if you have a spread, say on SPX of 10 points, and that's $100 per option. So then a 10-point spread would be $1,000, right? Mm-hmm. Now you are receiving cash. So if like that 10-point spread, you received, $1, let's say, mm-hmm. So then it's $1,000 minus $100. So the total risk that you can lose there is $900, and the most mm-hmm. you can make is $100.
Okay. So the point there too, an important point to note on these, I'm going to say 1 by 1, which I mean by that is a ratio of 1 to 1. There's no ratio on these spreads, so it's 1 to 1. On the straight credit spreads, I like to call these risk defined. What that means is that once you set this trade up and you get your credit, you know exactly what the risk is, right? Just as Jason just elaborated on. It's the difference between the strikes less that credit. That's your max risk in these credit spreads. Okay, so that's defined. Okay, and then we can maybe get into it later in the show, talking about the gymnastics of, is that a good enough credit you're getting for the risk you're taking? Is it the probability of profit and expected value of this trade makes sense to do? That's a little bit different conversation for now. Maybe we hit it at the end, but hold off on that thought. Okay. Next thing, you have a billion choices on these credit spreads of where you set the short strike and how wide you set that long strike. So whenever you set the short strike, how wide you set that, you're increasing risk. So if you have a dollar wide credit spread and you move to 2, you doubled that potential exposure, then the 3, then the 4, then 5, and so on and so forth. How do we set that sort of thing? Do you guys have a little rule of thumb on, you don't have a bias on which way the stock's going? You think it's a good implied volatility to sell this credit spread? Whatever reason you have, where do you place the short strike? Do you have any rule of thumb? I happen to have one. I'm going to turn it over to you because I've been talking too much. Mark, what do you think?
You're pretty close with the fact that you do have a billion different choices, because literally with the number of strikes out there, that's not that far off of an exaggeration.
Right.
I think, where you set that is kind of going to depend, sort of like you were saying about what your kind of angle is on this trade. Like if you're making a directional play, if you're kind of going for an expensive vol position, why might inform that a little bit, but I'm going to generally go with my old out of the money stalwarts somewhere in that 15 to 30 delta range.
Okay, fair. I kind of play that game too. That is 100%, fair on that. I'm just trying to get a chart up here too. So let's pretend that you don't have a huge directional bias. You just think volatility is right. You want to sell a little primo, and we could talk about an iron condor, which is the call and the put spread, credit spreads together. The short one, that is. So you're like the 15 to 30 delta. Is there a favorite in there? My favorite's like the 25. That's just me. Anyone have a comment on that?
That's a good one.
Okay, 25 is here.
There are many like it, but that one is yours.
Okay. I happen to like the 25. It feels very cozy under my arm, and it feels like I can do a lot with it. Jason, any ideas?
I personally, I use my platform Volin to determine what my strike will be.
Tell us.
So Volin gives me the strike where the dealers will have most impact. For me, I look at how much put support that dealers will supply at certain levels, and if we are start to hit that kind of support or go into that support, that's when I usually sell a credit spread. I expect kind of a move up, and typically when the market moves down pretty strongly, you end up with much higher implied volatility. Last Monday, VIX shot up quite a bit, even though the market didn't go down like a ton, like 1% or something like that, and VIX shot up a lot. That's the time, even though it's very scary, those are the times to start looking at credit spreads. And so I look at Volin to see where the support is. So I don't use like a standard delta. I feel like I have an edge in where I place those short strikes.
So relative to that comment, are you looking at where dealers have gamma, where Vana is, where charm is, all of the above?
Yes.
Okay.
Typically, on balance, like on the margin, dealers typically have a short put position and long call positions around that price.
Yep.
When you start penetrating into that put position, that's when, and usually VIX or volatility expands pretty strongly when that happens. That's when you could start looking at credit spreads. And typically I look at the area where, nowadays especially, I look at the area where I find the most support, and I go maybe like 100 points or 200 points, 100 points on like SPX, further down on that. And that's my risk management.
Right. Okay. Fair.
Yeah.
Fair. Mark, how about you? You said the 25. You said you gave me your strikes, and then any other thoughts on that? And I'm assuming you're not using too much of the gamma thing, right, for your stuff?
No, not specifically. But I think speaking to the width aspect, I think my process generally is you set that short strike, you pick kind of where you want to be selling something, And then, I think Jason made this point earlier about like the spread width is really like your risk management lever there. It's your biggest one, right? It's the ultimate one that, the OCC will guarantee that you do not lose more than that amount of money. Right. But you can also think about like the bigger that spread is, you might not wait for that to be your full risk management, that you can take bigger spreads, take more risk, and then manage them some other way, that you can manage them using stop losses or take profits. So, I think another thing to think about when you're setting up these spreads is how you plan on actively managing that position over time. Is it a dollar wide one and done coin flip, or is this something that you might stop loss, you might roll if something happens?
Yeah, that all makes sense. So let's do this.
Yeah. So when it comes to width, the way I look at width, when you do two strikes right next to each other, it's about as close to a binary option as you can get. Mm-hmm. But every single strike you pick from your short strike, you can almost see it as like another vertical. So like, your prime vertical is that short strike that you're using and the one next to it. But then each one you move down, it's almost as if you are doing another vertical all the way down to your long strike.
You are technically, because if you think about it, if you do that other vertical, you're canceling out the long and moving it to another place. So it is exactly that.
Yeah. So if you were to put, like, say, when you decide your long and short, if you put the short all the way down to where you wanted your long to be, then you're not going to get as much premium. And so it's going to be, kind of less efficient, I guess you could say, of a spread, but there's a lot less risk to getting to that long strike. So that's kind of how I see it from a risk management perspective. And in addition, if you put a very narrow vertical and it is far a longer tenor, so like 2 months out or 1 month out, and you have like a very close vertical, you're not going to realize the gains that you're looking for right away. So typically, like, the wideness for me is dependent on how far out my in expiration my vertical is.
Okay, makes sense. I'm gonna have another question for you guys. Let's go to the screen real quick. Mm-hmm. I'm gonna give a little Lex flavor here and see if you guys agree. So, are we going to the screen? Are we sharing? There we go. Okay, so I just have spiders up here, and I picked these two strikes for my put credit spread. Can you guys see that? Can you see my mouse moving? I think you can.
Yep.
One of the things I like to do too, depending, when I don't have a directional bias and I just want to sell a put spread, just pretend that's the answer, is I do like to look at that straddle. I know Mark and I talk about this a lot. So this straddle, let's call it about $5. So the straddle is the at the money options, add them together, the call and the put. They come out to be a number. I just called it $5 just to round. And that's about where I would typically look to set my short strike. Incidentally, it becomes out to be about a 27.5 delta. Now, I'm not going to argue with you, say, I want more protection, I'm going to move down 2 strikes. Okay, great, wonderful. We're dropping grenades, as I always say. Not a big deal. The point I like about where this long strike exists. Now, if I move it out a little bit, I get more risk. If I separate this out, the further I separate it out, all of a sudden I'm going to be like a strangle almost, right? Sooner or later. Okay, which I'm not going to argue against. I still like to say in this trade, right, my risk threshold is going to be about 2, 3 to 5% of my equity on this trade. I don't want any more than that. So that means I can go 2 strikes. I might do that. If I can only go 1, I'll do that. But I'm going to have that as my thumbnail to say I can lose $1 on the spread less less my credit spread. So that's 80 cents in this equation, $80. Okay. If I can do 10, that's 800. Now, maybe I want to get a little more and do fewer ones based on that 3 to 5%. That's a different argument. But that's how I like to look at those things, on these things. The second thing I'd say, and this is for you technicians, which I am not. I have Tesla up here. You might say that this is support where my cursor is. I don't know if this is support or not because I don't read charts. But let's pretend it's right here. Well, that seems to me, all things being equal, and if you take Jason's gamma and Von and Charm charts and some of the things that Mark talks about as well, this might be a good place to sell a put spread because you feel there's support here. Okay, so there it's about the 315 strike, if you can see on the right there. Wonderful. Don't disagree with that either. Okay, I can't tell you that I'm a chartist and understand that, but that's what you do. This is also a good spot. how far you separate. Again, back to our 3 to 5% on this one. Now, where it becomes interesting, and this is to Mark's point, what if you get breached? You're wrong, or you're potentially wrong. In Tesla, for instance, what if we go down to the 315 strike? You're losing money. How do you manage it? So, Mark, you want to make a comment or two about that one?
Yeah, I think a lot depends on the duration, right? Like on a very short term, spread or similar to a very narrow spread, there's not much management that needs to happen. That's like a very targeted,
Sure,
one kind of coin flip, one turn type trade. You'll want to make a lot of them for your portfolio, but that specific trade, short term, tight strikes, you don't really spend much time managing. Once you start opening up that spread, whether it's because it's longer duration or longer widths, there's going to be a lot more play that happens in the middle there. And, think about rolling, I tend to, if I'm selling something out of the money, call it the 15 or 20 delta, by the time that starts creeping up to 40 or 50, that's a good roll trigger for something. Same with time, you might actually reset a spread just purely based on time. And then I'll credit Doug in the comments, actually, that he brought up another management point, that wider spread is going to require more management come expiration, because the wider that spread is, the more of a chance it's going to land in the middle. And if you're not trading SPX, you might end up getting delivered on some stocks. So if you're trading a credit spread and you're short that put, be prepared to buy stock.
Yeah, those are all great points. And I've seen, I guess the third part of this equation, which isn't in the question, is what you mentioned is time. Do you put this on 0 DTE? Do you put it on in 10 days? Do you put it on at the 20 day? Do you put it on at the 30 day? Where do you choose your time frame, right? And I think, for me, that is that's a question for the what kind of personality you have. One's a day trade and one is a swing trade, and I like the swing trade version because it gives me a little more time to let things happen. You're probably not going to get pierced on a move against you when you do it in the swing zone. Let's call it 10 to 30 days out ish. You probably have a little bit of wiggle room and dancing you can do. Whereas opposed to 0 DTE, you're getting your answer by the end of the day, right? And as Mark said, man, that could be a coin flip, by day's end. So I don't know if you guys have any thoughts on what point in the time calendar do you do it?
I personally like having some time to, there's so much that can happen in the short term that doesn't jive with whatever thesis you have, and you have to be sitting there with that button ready to click all the time, and that's just not my personality. Right. I like to go outside once.
Yep, I got you.
I think if you're thinking about the short term, you should be thinking about doing the short term over the long term, right? Yeah. Like if you're trading SPX 0 DTEs and you have a strategy on that, like you should be thinking about what 50 flips of that coin look like, not what every single day is going to zig and zag like.
Yeah, exactly. Now, do you guys look at probability of profit on the spread versus probability of loss and do the mathematics of expected values? It's a positive number, blah, blah, blah.
Every time.
Okay. And your system does that, or you just do it on the old back of the envelope?
No, I mean, it's so, if you're talking about my system, Volin doesn't do that. That just kind of gives you an idea of the strikes. It gives you an idea of where to put the short strike. All the time, I kind of look at, I look at what the distribution that the market is implying and the distribution that kind of Volin is implying, and then I measure out personally if there's a disconnect, and if there is a disconnect, is that made up for in the spread? Like, what is the spread's probability of outcome, and what is mine? And that's how I do it. But
okay,
I'm a little heady that way, I guess.
Yeah, gotcha. Now, let me ask one final question to get your thoughts on this, right? Is there ever a time when you will sell just the strangle and forget about the long wings?
No.
Is that ever advisable? Even with a lot of money?
I don't like it. I mean, at least buy a wing way out. Because the thing is that you end up using a ton of margin when you do something like that. You have to, use the margin from your put all the way to zero. And then the call, I mean, it depends on your broker dealer, but, typically it's like double your put. So it's just a ton of margin. So personally, I don't do that. And that's more of a risk management reason.
Okay. Mark, any thoughts on that one?
It's tough though, because that's where you're giving up that sweet VRP by buying the tails. That's the most expensive stuff out there. And like, it's, I think from an academic perspective, the answer is you want the strangle all the time. From a, I have to live with the balance of my account perspective, like you got to lift some of those wings.
Yeah.
Yeah, that's the thing. It's a risk management thing. I know Mark is right. Academically, you don't want to buy the wings, but from a risk management standpoint, converting from professor to trader, you got to buy the wings. Like I can't live without
unless
that.
you have a really, really deep account and you're totally prepared for what that blowout looks like.
Yeah. The old black swan, as they say, and it happens more than you think. I've lived through several, and back in the '87 crash, as we talked about last show, there was someone who was going to take down a clearing firm because he was short strangles, right? And guess what? He made money hand over fist, day in, day out, month in, month out, until the crash came, and then he gave it all back and then some, right? No wings. So look, I got to tell you something. I agree with Mark. Academically, probably mathematically, it probably makes more sense to just sell the strangle, right? I get it. But I lived through that, and I had the upside version of it on a takeover where I wasn't covered, and I was net short calls, and it hurt. It was painful. And I said to myself after that one, I managed out of it, but I said after that one, never again will I be short units, especially puts, but also calls. I'll buy the wings and pay the insurance policy and just be like, okay, I can sleep at night. I know what my ultimate exposure is here. That's all I need, right?
Yeah, sometimes you got to pay your lunch money, man.
But that's your lunch money. For me, though, that's why, I probably technically doing a lot of strangles in the old days, quite frankly, with that long call, and that's when I separate those strikes pretty good, because I can handle the difference. I can handle that separate strike pretty good. And I'm going to be making more money because I have more money to use, right? In that equation. So there's no reason for me to make a tight iron condor when I can afford to make a wider one with the capital I'm using, right? And I want to push the accelerator as hard as I can without being stupid, right? Yeah. I don't know. That's how I feel about it. So, all right, what else? Anything?
One thing I will say is something that Mark kind of, mentioned real quick, VRP, which stands for variance risk premium. A lot of people, I noticed there's a growing number of people out there selling iron condors or, credit spreads or whatever, because there's, statistics out there, 90-something% or 80-something% of options all expire worthless. You might as well sell them all and hold them to expiry. I just say be careful doing that without prejudice, without some kind of idea, don't just sit there and sell credit spreads once a week, every week, without paying attention to the market. The market has a tendency to punish people who do that.
It has no feelings. That's ridiculous.
I haven't updated it in a couple months, but it was back in June. I ran a study of every day since SPX 0DTEs were introduced. If you sold that straddle every single day, average price of it, I think, was on the $30 range. So just to center around that, I think the P&L from doing that was negative $60.
Really?
over the prior 3 years.
I remember reading that. Yeah,
that stuff is incredibly well priced. You have to, throw in a little more sauce than just collect VRP every single day.
Yeah. And people, that's awesome.
And people look at the increased implied volatility percentage on 0DTE and think, oh, this is the best time to sell options because it's 18 today, it'll be 16 or something tomorrow. When I was looking at your trade hawk, that's what I saw. I think tomorrow's NFP too, right? So, so even that's elevated. So it's 18 today, 11 tomorrow usually, and it's I'll sell today because there's more implied volatility. But like Mark said, the 0DTE dealers have gotten very good at pricing 0DTE.
Oh, yeah, for sure. Yeah,
even if there is higher VRP, I don't like selling around those events anyway. That's actually one of the filters we use in our bots. You don't get paid enough more for the risk in those days.
Yeah, no, I agree.
In my humble opinion.
I agree with that. I think I've thrown in the towel on the 0DT part for now.
Oh, come on. SIBO just, they announced a new record, right? The average 62% of SPX volume is now
Not
0
because of
DTs.
me. I think it's a great product. I think it's awesome. And I think it has a value for people. I just can't find it. This made me finally tell myself that I am not a day trader. I had that final come to Jesus moment. I'm not a day trader. I'm a swinger. Did I just say I'm a swinger? I'm a swinger. I can't do the day trade. It freaks me out because I know I've got a day to go or 6 hours to go, and I make the wrong decision all the time. Whereas if I have 10 days, or I don't care if it goes against me a little bit. I know, I'll do my thing.
Yeah.
I just feel too panicked.
Lex had to go to day trading rehab, huh?
I had to go to day trading rehab. Yeah.
Call 1-800-GAMBLER or 1-800-DAY-TRADER.
Having said that, if you are good at day trading, to me, it is the best gig on the planet. If you're good at it, okay? And that means obviously you're making money at it, because why? You have a position during the day, you take it off at night, and you have no jump risk overnight, and you have no weekend risk, you have no news risk, and the money's in the bank every single day. That I like. I wish I could do it. Can't. So I get to take jump risk.
I can't either.
Yeah. Mark, I think can. He's looking at me funny. Mark, you're looking at me funny out of the side of your eye.
No. I do not like jump risk. I like to keep my gaps in check.
Yes, I'm with you on that. No jump risk for me either. All right, boys.
A little bit, but not a lot.
I'm with you. A little bit's fine, not a lot. Okay, good. Good talk, good show. Have a great weekend. Thursday, please subscribe to the channel with Smart Options Trader and Trader Hub. We do have a new channel coming out. We'll talk about that another time. And Mark, harvestedfinancial.com. Is that right?
Harvestedfinancial.com.
Jason, vol.land.
Yep, right on.
And we love comments. We love interaction. If you have a topic that you'd like us to cover in the future, I know we can't do it now because we're leaving, but send me an email, lex@tradier.com, TRADIER.com. I would love to talk to you and love to hear your comments and your topics, and we'll tackle them. Right? Anything else, boys?
Happy trading.
Happy trading. You guys have a great week, and so do you, everybody. Have a great one. Talk later.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.